Hello, this is Brian Shannon from AlphaTrends.net. Today is Friday, the 6th of June, 2008, and the market's been closed for a while here. I've been busy signing books today and getting things ready for shipping tomorrow. Looks like leaving at the time I did, which was about midday, was the right thing to do if I was trying to pick a bottom at least. But clearly the short sellers were in control today. And yesterday, what appeared to be a very strong bullish action was quickly reversed today, as it seems as though oil reached a clear breaking point for this market, and it was unable to sustain, obviously, the gains that it saw on Thursday. So, looking at an hourly chart here to start out, we've got the market below the 137 level, and that puts back into play the head and shoulders pattern that we were looking at. The market yesterday made it up to this level right here where we had the potential for resistance at 141, and in hindsight it turned out to be a very strong level of resistance as the market couldn't make it past there, obviously. We had news this morning from the employment numbers, and market responded by gapping lower initially. Tried to recover up to the 2-day VWAP, and then it was just a slow, steady sell-off. Not even slow, I don't think is the right word for it, but just a steady sell-off throughout most of the day as oil just continued to charge higher, and shorts are just getting buried in oil. Here's a 2-minute time frame of oil, the USO at least. And on the daily time frame, massive volume again. There's a big short position in oil, and those guys are clearly feeling the pain. This is why picking tops is one of the hardest jobs there is on Wall Street, and I'm sure there's a lot of people losing money betting against oil right now, just based on the emails that I saw earlier this week. A lot of people were looking for oil, but the trend line remained intact. The 50-day moving average remains higher. The 50-day moving average is above the 100-day moving average, above the 150 and the 200-day moving average. So, in other words, we have a rising 10, 20, 30, and 40-week moving average, and these trends just don't reverse very quickly. When it comes to the S&P 500, the weekly time frame again remains the key, reason for concern about this market continued. And one day it might look good here, but then the next day it completely falls apart. As I say often, that if you expect nothing out of the markets and prepare for everything, you should never be surprised. Defense wins the game, and even if you got long into this yesterday, you should have realized quickly that there was a problem. And I had said yesterday that it looks like the buyers were back in control as long as it could hold above this 139.20. And that level was violated very quickly. And I didn't really, I left about, I think, this point during the day. I was kind of expecting the 137.50 level to hold, but obviously nothing held, and people were just giving up here at the end of the day in the S&P 500. Now it looks like, if we go back to the 120-minute chart, that is, 2-hour bars, candles in here, we've got this head and shoulders pattern that is now really back in play, and you could say it was a double-shouldered, whatever you want to call it. The point is, it broke important support here at 137. The height of this pattern takes you up to about 144. So the height of this pattern here, 144 down to the neckline of 137, is 7 points. So we would subtract 7 points from the break of the neckline, and that would give us a bearish objective of about 130 or so. I've been saying over and over that this is a trader's market, and clearly the volatility that we saw this week, I think, really puts a stamp on that statement. That how can you really position yourself for a longer term? Except maybe you could make a much bigger bearish case, as I've been saying here. The XLF rallied up strong. It's coming down, and the financials here on the daily time frame broke decisively below 24. Now it looks like the Bear Stearns lows are likely to be tested, and if they hold, who knows? If they don't, the bottom line is this market remains in severe trouble. It's in a downtrend, and it looks like there's probably still further selling ahead. Back to the S&P 500 here on the daily time frame. We're back below that 50-day moving average. The 50-day moving average is flattening out. We've got a 10-day and 20-day moving average, which are declining. And, the height of the pattern suggests a move down towards 130. We've got potential for support in at a couple levels, here from the gap at about 135 right here. Then these lows right in here at about 133. Obviously, nothing goes down, straight. This level right here at about, well, let's just call it 137.5. That's going to be an important level that the bears are likely to defend on any rally attempt. Maybe we get up towards even as high as 138 on any bounces in here. But with a declining 5-day moving average, obviously the burden of proof remains on the buyers here, and the S&P 500 remains in some deep trouble here. It's on this longer term level of support was tested. It looked like maybe it tried to break above there about 3 weeks ago when it got back above the 200-day moving average. What we didn't see here this week, though, was a higher high. As we saw, this market's been making the lower high and the lower low, and it was unable to make the higher high here. Today we had a lower low, so now this market is truly in a downtrend with two lower low highs and 3 lower lows in here. So continue to be careful. Take this very seriously. This market has big troubles. The Russell 2000 really looked like it was getting past that key level at 75. Closed, on Thursday above, 76.25 or so, but today down at 73.92. That's, from failed moves come fast moves, and that's what we're seeing here today on the weekly time frame. This is just an ugly looking candle, spinning top, bearish, whatever you call it. Don't focus so much on what the name of the candle is whatsoever, but basically it probed much higher. The sellers got back in control. The market closed below where it opened this week. It traded big volume, and it looks like a reversal candle, basically. We still see, though, that this market remains above the relevant trend line in here. And in a trend line, do you want to draw the trend line off this low and then, try and make this? You could make a case that maybe there's the trend line, but I went through the price, so we could redraw it here. Drawing a trend line isn't a perfect science. And Larry McMillan, the options strategist, said it best, which is that you draw trend lines with a crayon, not with a pencil and a straight edge. You want to capture the essence of the trend. And I think this line captures the essence of the trend best. And we remain above there. And you could, again, look at the look at oil and how it responded to its trend line. It doesn't mean that the Russell will do that, but this market was the leader on the way down. That is, it broke down first. Besides the financials, I'm talking about broad market averages, not one sector specific group. But the Russell 2000 led this market lower, and then actually it led the recovery here since the January lows by not making a lower low here in March. And now we've got to just continue to be very cautious in here. And I got a good email on Thursday that said, Brian, I missed the point. We got this big rally, and you weren't, you didn't remind us to be cautious. And I responded by saying that you always have to be cautious. Again, if you expect nothing from the market and are prepared for everything, you should never be surprised. The market shouldn't surprise you when it makes these moves. I look at this market and try not to be influenced by the longer term trends and that sort of thing. But when you look at what's going on here on a macro basis with oil exploding to the upside, unemployment numbers rising, it's hard not to let that sink into your subconscious. But really, again, the only thing that pays is price. Thursday it looked like a bullish breakout here, and then today we saw a complete failure of that. So that's what you have to focus on. You have to focus on the fact that the market remains in this downtrend. And I just had the wrong vehicle up there, but the market remains in a primary downtrend on the weekly time frame, and that's that's where the problems are. You could say, well, is it really a downtrend, or is it just more of a transitional market? And I think it's probably on the Russell more of a transitional market, But the way I define a bear market is by the direction of the 200-day moving average. I make that clear in my book that it's the direction of the 200-day moving average. It doesn't mean in a bear market there aren't some great rallies, and we've seen some huge opportunity here the last 2.5, 3 months to make money on the long side. But now the market is telling us a message, and the message is that risks are very high in this market to the long side. And the short squeeze rallies are so quick that I really will continue to preach the case that it's a trader's market. Where do we have the potential for support in the Russell? I think this trend line, 73.5, right there. But we had this, large breakout. From these failed breakouts often come fast and large moves. So just be very careful. Don't be looking to buy pullbacks. Wait until the market gives you a solid technical reason before you start to buy. Yesterday, again, it looked like there was a solid technical reason when it got above 139.20. And as I said also, if it breaks that 139.20, then, basically cancel your long bets because sellers are back in control and there's just too much confusion in this market. I didn't expect this to happen, but I think I said it 2-3 days ago. If I had $1 for every time the market did something I didn't expect, I would have a large pile of dollars somewhere. And, that's why you have to just remain objective and listen to the message of the market. The only thing that pays is price. Let's take a look at this Dow, because the Dow Jones was, again, the biggest reason for concern coming into this week. From last Friday, I was saying that 127.50 acted as resistance once again. Now we've got this 50-day moving average flattening out. We still had a lower high and lower low in here. Even though on Thursday we had a big rally in the Dow, it was unable to make a higher high. And that really, told us that these types of rallies within a primary downtrend are only something that should be attempted by the most nimble traders, the traders of the shortest term time frames. And with a declining 5-day moving average, you want to be in and out of these things quickly. This market just sold off, steady all day long, just like the rest of them. Let's take a look at the NASDAQ. The NASDAQ was, still remains in a solid uptrend. You look at that; it's right on the trend line. I don't think this trend line will hold again. A lot of people call it the rule of 3. The third, after the third test, it typically will break. Looks like it probably will continue to see some follow through on the downside. We're back into the range of 48 to 50. Looks like we're probably heading back down towards the test of 48 to 47.75. But we've got this rising 50-day moving average, and clearly technology is a much stronger area of the market. But right now, nothing is paying on the long side pretty much except for oil. And all the emails I get say, oil's topped. This is the end of it. And picking tops and picking bottoms, picking turning points is an inexact science. What we want to do is we want to wait for an alignment of trends. What we're seeing in here in this NASDAQ is just a lot of real choppy action in here lately. And with big volatility, a lot of times, with all that emotion in there, it comes at short-term turning points. So perhaps this NASDAQ is starting to play itself out to the upside. And markets don't have to crash just because they're overdone on the upside. They can correct one of two ways. They can either correct price-wise, and maybe this market completely fails, but it's got a solid base of support under it. So 47.75 is going to continue to be important, and then we've got this level down here at 46 and change, and then below that even at just about 44.80 or so. So we've got potential levels of support in there, but let price action dictate what you're going to do and guide you. But again, prices can correct either. Markets can correct either price-wise or through time. It's possible that the market just starts digesting the recent gains and turning sideways. Either way, we're in a high-risk market. Respect the risk, hold on to your capital, and trade smart.